Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast. Today, our special guest is Ron Hera, who is founder of Hera Research, LLC, and the principal author of Hera Research Newsletter. Ron holds a master's degree from Stanford University and is a member of Mensa and the Ludwig von Mises Institute. Ron's a native of California and is a self-described escapee from Silicon Valley, California, and he was originally a serial entrepreneur and a private investor in communication software and mobile technology, and now he is invested in natural resources, and he runs his newsletter, and he specializes in precious metals after the dot-com bubble burst and the stock market crash in 2000. Thank you for joining us here today thank you for joining Mo Dawood and I today on a Wall Street for Main Street podcast, Ron Hera.
Good to be with you.
Hey, Ron. Thank you for joining us. First, I'd like to start off talking about the gold and silver market. We're close to wrapping up the year 2011, and I just want to get your thoughts on the market in general for this year. Some people have been disappointed with the way the silver and gold market has gone this year because a lot of people predicted silver will be at 50. I heard some people think gold would have been at 2,000 by now, but that didn't work out. So what's your thoughts on the gold and silver market?
Well, I don't make short-term price predictions. I do believe that we're in a long-term bull market here and that the trend for the metals is upward, and there are a variety of economic and monetary reasons that are behind that. Having said that, I think this year has been fairly disappointing for investors in mining shares specifically. It's been a very volatile year, and we haven't seen the kinds of gains we hoped for, even though the metals prices are up significantly, in fact. So if you look at it year over year, for example, if you look at the HUI versus gold or the XAU versus gold, you'll see that the disparity between the metals prices and the mining shares hasn't been this high since 2009.
That's very interesting, Ron, because we're just starting to see the real cash flows here in the mining shares, especially from the larger producers like Goldcorp, Newmont, and Barrick. And you're seeing share buyback programs announced and dividend increases, and you're starting to see some decent amount of acquisitions here.
Yeah, I agree. I think the timing is very good. For those long-suffering investors who've been waiting for the mining shares to finally start catching up with the metals, I think we're likely to see that in 2012.
Yeah, one of the reasons I think the mining shares performed poorly this year is because just Wall Street and the mainstream media refused to take a look at this industry. I mean, profit margin is increasing. I mean, the dividend is increasing for the big producers. Silver Wheaton increases their dividend. Do you think they'll start paying attention to this industry with the increasing profit margin and the dividend increases?
I think it won't matter because I think that investors are going to move into this space based on the fundamentals and the financials of these companies. So when you look at the mining shares, especially the ones that I cover in my newsletter, I cover a lot of pre-production and development stories. But once a company's in production, especially if they've got a compelling growth story, like a Silver Wheaton or like a First Majestic Silver, for example, these are companies where the actual cash flows and earnings are going to keep improving. And as long as that's happening, investors are going to come in. If you just think about what I call share price mechanics, as the PE ratios fall, the investors will come into those stocks. They're going to look more and more attractive, and that increased interest and increased investment is going to drive the shares up.
Now, Ron, do you think it's important for people as a general strategy, because of the volatility in a lot of these mining shares, that people take a long-term and disciplined approach, and they make sure not to buy their positions all at once, and that they keep a certain amount of cash on the sidelines there to keep averaging down, as long as the company has good fundamentals and the management's executing the growth plans?
Well, if you have a lot of cash, I should say I don't offer financial advice. What I cover in my newsletter is my own investment portfolio and my own strategies, my own investment decisions, and so forth. So, I tend to be almost fully invested. I know it's a lot of people think you should have maybe 25% cash, 30% cash. I have a lot less cash than that. I don't have no cash, but I shop for things that I believe are undervalued. And sometimes the market volatility will cause prices to fall further from what my original entry point was. And in those cases, I believe that they're even further undervalued. And in some cases, I'll buy more of those particular shares. For example, Global Minerals, I bought that stock around the time that the Sprott organization invested in the company, and that's a stock that I think is now almost half of what the price was at the time that I determined it was a good value. So in other words, I would see that as a better value now, and in fact, I have purchased more shares.
I agree. The mining shares are very undervalued, and it's pretty good time for people to take advantage of that before it's too late. I'm not sure how 2012 will be for the mining share, but I think it will be a lot better than 2011. So I want to ask you about 2012. What is your outlook for the gold and silver market for that year? Well, it depends on what the central banks will do, like the European Union and the Federal Reserve. Will that determine your forecast for 2012?
Yeah, I would add that government deficits will have a lot to do with it. I mean, what we're talking about is policy inflation, and that's inflation that's created through government deficit spending and through central bank money printing. And those two things are liable to drive commodity prices and metals prices higher, just as we saw during QE2 when the Federal Reserve was essentially monetizing U.S. government debt in the bond market. We saw oil spiking. We saw commodities driving higher. We saw food riots in countries around the world. So the central bank policy really does have a great deal to do with where the metals will go from here. And I would point out that central banks are now net buyers of gold. So I think the future for gold is very bright indeed. I would certainly expect to exceed $2,000 gold next year. I don't even think that's a controversial statement. And one of the reasons I say that is that I don't really see any economic recovery on the horizon for the U.S., and nor do I see any foreseeable way for the Eurozone to resolve its debt problems, and that means more debt monetization.
Yeah, I agree with you, Ron, on your price target. I'm expecting between $2,000 and $2,500 an ounce gold sometime in 2012, and I think that you would be more accurate on that than the Wall Street sell-side analysts who have, I believe, the average price target for gold is $1,300 an ounce going forward in the future for the sell-side analysts, which is, pretty ludicrous to me.
Well, I'm not selling mine, and the reason is that I expect more deficit spending and more money printing, and I don't see any economic recovery on the horizon.
Great point. I want to shift gears here. Since you mentioned deficit spending, one of the consequences for deficit spending is that it could lead to an inflation because of the money printing. Now, I want to discuss the inflation-deflation debate a little bit. For the viewers out there that doesn't understand how the economy works exactly, is it possible to see inflation and deflation at the same time?
Yeah, in fact, that's a very good entry point into the discussion of inflation versus deflation. Usually it's couched in fairly simplistic terms as two alternatives that are mutually exclusive. And that's not the case, because there's different ways we can talk about inflation. Obviously, in ordinary terminology, we say inflation, we're talking about prices rising or prices falling. What's important to understand is that those price changes are driven by the amount of money that's in the economy. In other words, the quantity of money. And that's what inflation really is. It's changes in the quantity of money. Prices change because of that. So that's the cause. The cause is actually the amount of money changing. Now, you can have inflation, and it can be induced in various ways. As you know, money is created in the economy through lending activity. And if there's not sufficient lending activity to create money in the economy, money can be created through debt monetization or through government deficit spending, which is basically borrowing. I mean, that is a form of lending, actually. And, of course, that's inflationary. So those are two other ways to talk about it. In addition to that, we can talk about debt as being inflation or deflation. So debt deflation specifically would mean that there's an excess amount of debt in the system, and that debt is unsupportable, and therefore you have debt deflation. So to make a long story short, yes, we can talk about inflation and deflation as things that happen at the same time. You can have policy inflation, which is what we're seeing now with bank bailouts and government deficit spending and debt monetization by the Federal Reserve, that's policy inflation. It's cost-push inflation because they're pumping money into the system, but only into the financial market, essentially, or for the most part. Then you can have debt deflation, which is what we're experiencing. We have an excess of mortgage debt, for example, and overall the total debt level in our economy in the U.S. is excessive. It's not supportable by GDP, whether you're talking about student loans or credit card debt, or whether you're talking about the government debt itself. The total debt level is absolutely not supportable, and the math just doesn't work. There's no combination of economic growth or taxes that will ever allow that debt to be resolved. So that debt has to deflate. Now, what the Federal Reserve is trying to do is meet the debt deflation halfway. They're trying to slow the process of debt collapse by debasing the currency, in other words, policy inflation. So there you have deflation and inflation happening at the same time. And their hope, of course, is to control the rate of descent in the dollar and to slow the rate of debt defaults so that the banks don't fail.
And I think that's a great explanation, Ron, in many details of financial repression, which is what the government, mainstream economists, and the academics have written about, how, they want this controlled amount of inflation to devalue the debt, to pay it back in cheaper dollars, and to pay, people Social Security benefits, government employee benefits, and stuff like that back in cheaper dollars. And, that they've gotten very clever with disguising the inflation too, because with the statistics, like with GDP, our real GDP when accounting for real inflation rates is negative. Our CPI, the CPI is obviously understating inflation because it keeps using, substitution and hedonics and geometric weighting and some of the other things. So yeah, I think eventually a lot of the inflation, like you said, it does start off in the capital markets, and a lot of it gets speculated with. But, if it's speculated with in commodities, those commodities eventually need to get bought, and then those eventually do go into the real economy in the form of goods and services, and then that's when it starts causing, real pain to people. Yeah,
there's a couple of problems with the policy as it is, although I would point out that it's basically the only policy that promises to prevent the major banks from failing. It's the only policy that really can prevent a major breakdown of the financial system, and that is to do just what we're doing, which is allow banks to mark their assets, to model instead of to market, bail out the banks, increase their capital ratios, and infuse cash into the capital market so that they'll have plenty of cash. There's just a couple of problems with this policy, and I stated what the reason for it is. One of the problems is that it distorts the distribution of money over the economy. In other words, if you look at the real economy, so consumers, small businesses, and so forth, the broad U.S. economy, we actually have a deflationary environment. And by deflationary environment, I mean that we have high unemployment, so there's fewer people who are receiving paychecks from businesses. You have debt service, which is draining cash away from the economy, broadly speaking, because there's and this is the other part of it, there's actually a relative lack of lending. So you have very little lending going on to consumers and small businesses, but you have debt service draining money away, and at the same time you have an unemployment problem. So you clearly have a deflationary environment in the broad U.S. economy, in what you could call the real economy, or what you might call Main Street. In the meantime, to save the banks, we're basically printing money and handing it to banks in the form of bailouts and in the form of bond purchases, which inject cash into the bond market. And of course, that cash could flow anywhere. But what's happening is, as money is being drained away from the real economy, it's being recreated in the banking system because of the policies that we have.
Great point, Ron. One of the main concerns with our economy is the inflation policy taken by the central bank. Excuse me. Another problem that this economy is having is the amount of leverage all the banks are taking here in the U.S. and overseas in Europe. Mainly the derivative market. For example, MF Global that went bankrupt recently because of all the leverage they took by betting in the Euro bond market. Now, what are your thoughts about the derivative market in this country, and how does it impact the economy?
Well, first of all, I would agree with Warren Buffett's early assessment of OTC derivatives as weapons of mass financial destruction. And the reason I say that is that these are bets that are essentially not regulated. They're bets that amount to over $600 trillion globally right now today. And they're bets that, just think about the numbers, that's more than 10 times world GDP. These bets can't be covered. In other words, the losers will continue to go bankrupt when these derivatives contracts are triggered. And this is a problem because that means that there are basically landmines throughout the financial system. In other words, firms that are going to explode. And that, just like MF Global is just the latest example. From the beginning, OTC derivatives have caused this problem. They caused the bankruptcy of Orange County, California. They caused the bankruptcy of Long-Term Capital Management, for example, LTCM. And they just caused the failure of MF Global. If you go back to the crisis of 2008, the reason why we had to have a policy of too big to fail, the reason why the Western countries, not just the U.S., had to bail out the banks, was that the banks had OTC derivatives exposure in the trillions of dollars. In other words, if they'd allowed banks, the governments, in other words, if they'd allowed banks to fail, there could have been a cascade effect. In fact, there would have been, where the failure of banks would trigger further OTC derivatives contracts that would then also cause further banks to go bankrupt in a cascading effect or a downward spiral. So that was the true reason. It's very important to understand, this is not well understood, that the true reason for the bailouts, the true reason for the too big to fail policy is OTC derivatives.
Yeah, and I think that's a great point, Ron. And we spoke offhand about the total derivatives market being over $600 trillion, and that's more, than total world GDP and total world assets. So, this is just ridiculous. And, I think this is part of the problem with our whole, banking and financial system, and the problem with the current paper fiat currency money system itself is this all a moral hazard. There's no personal, responsibility in it. There's, no fundamental incentive to do the right thing, to, make sure that you have all your risks accounted for. And, the policy, like you said, has just been a system of inflation for decades now, since the 70s when the derivatives market started. This whole thing has just been one big goal of just, creating the wealth effect in the asset market. So anytime there should have been a recession with Greenspan, with the tech bubble collapsing, we probably wouldn't have even had any of the problems we did now if Greenspan wouldn't have papered over the problems in the tech bubble.
Well, I agree with that, and I'd also point out that Greenspan, in fact, prevented, along with Larry Summers and Robert Rubin, prevented OTC derivatives from being regulated. Greenspan drove Brooklyn Bourne, who was the former head of the CFTC, out of Washington, D.C. when she tried to regulate OTC derivatives. So this is a problem that is now out of control. But I would get back to MF Global for a moment. That's actually a new chapter in the OTC derivatives story, because what you're seeing now is a lack, and this was started to become apparent back in after 2008. I mean, after the financial crisis, but what you're seeing is a lack of regulation and a lack of enforcement of the law. So in MF Global, the CME, Chicago Mercantile Exchange, stepped in and froze customer accounts. The CME and the CPM group did not guarantee customer funds. And those customer funds are now being accounted as part of MF Global's estate for the purpose of bankruptcy proceedings. So this is unprecedented. This is essentially like a crime wave, where there is, speaking of moral hazard, that there really is no incentive for these companies to follow any kind of ethical guidelines or even to follow the law, because the regulators and the Department of Justice have already shown an unwillingness to interfere with any large firm. They cannot cause the failure of a large firm because of the OTC derivatives problem. You see, so now we're stuck in a situation where it's basically a free-for-all.
Oh, I agree, and I think the CME caused a lot of problem in the market, especially the derivative market, by changing margin requirement all the time. I think the best solution is to keep the margin requirement at 100% at all time, and that would lower the risk that is out there. And I also want to ask you something else about the derivative. Do you think the derivative market has a place in our financial system, since the word derivative has such a bad connotation now?
No, I think that OTC derivatives, and especially the ones that are not backed. So in other words, when you have a credit default swap, that's a swap that covers you in case there's a default on a bond that you don't hold. In other words, it's basically a wager. It's a bet. That's all it is. It's gambling. It's pure and simple. It's gambling. Okay? So there's no connection to the underlying asset. That's a problem. That was illegal in the United States under state gambling laws, under gaming laws. That was illegal in the United States of America until the Commodities and Futures Modernization Act of 2000, which was championed by Greenspan, Rubin, and Summers. So we're in a world now where the fate of nations and the financial futures of hundreds of millions around the world is being decided by financial speculation, by gambling between financial institutions.
Yeah, and this is, what I think is pure rent-seeking, and this goes with the moral hazard stuff, and the fact that, back in the 70s and 80s, before Goldman Sachs, became a publicly traded corporation, when it was just a partnership and they were managing their own money, they didn't take the risk that they did, now. Because, it was their own money and they risked the firm going bankrupt, and the people at the firm actually cared about the long-term health of their companies. And we're just not seeing that now. Our culture, I guess, has gone to the point, our financial system, and I guess this is part of our culture too, has gone to the point where, people are only thinking about, at least the market is only thinking about the next couple months out and maximizing every single profit in the short term, Milton Friedman, predatory capitalism type of thing, and no one cares if their firm, survives the long term. Look at Corzine. He should be in prison for the rest of his life.
Well, that's a great example of moral hazard, and that's exactly what I'm talking about. We're in a new stage of the crisis where it's been shown that the people who make these decisions have impunity, that nothing will happen to them because there can't be enforcement of the law without causing these firms to fail. And if that happens, the OTC derivatives domino effect could take place. So you have a situation where basically there is no restraint. There is no limit on what can happen here.
And I agree. Until we get a change in leadership in Washington and get the regulator to actually do their job, this type
or remove them
or remove them. I mean, this type of behavior is going to continue. I believe there's probably more than one John Corzine out there doing what he's doing right now. I'm pretty sure.
Well, that's exactly right. It's not just MF Global, and that's a troubling question. If you ask why did the CME not step in to guarantee the customer accounts? Why are the customers being treated as unsecured creditors to MF Global? And I think I'm afraid that the answer might be that they know that there are other MF Globals out there. There are other commodities brokerages, along with big banks and hedge funds, that are speculating in OTC derivatives and that could explode at any moment.
Yeah, Ron, and Max Kaiser, I was watching the latest Max Kaiser report, and Max brought up how the $1.2 billion missing from MF Global's balance sheet, that was stolen from customers' accounts. Guess how much, exactly how much money JP Morgan has docked there from MF Global?
Let me guess, $1.2 billion?
Yup. This is, everything's tied together. So I'm wondering, I obviously don't have all the answers here, but I think it's very suspicious that the exact money that's missing is all at JP Morgan.
Well, I don't have any comment on that.
Well, let's shift gear. I mean, this relates to what's going on around the world, the Occupy Wall Street protest movement. Now, if you look at the message regarding the Occupy Wall Street movement, and you compare that to the Tea Party movement, if you look at it carefully, they sort of align with each other. Ron, do you agree with that?
Well, I think there's important differences, but I do agree that that a lot of the issues are the same. I mean, Occupy Wall Street basically, what are their issues? Their issues are unemployment and a lack of economic opportunity, falling wages and household income, growing poverty in our country, increasing concentration of wealth. That's a major issue for Occupy Wall Street. There's a looming financial crisis, a fiscal crisis in terms of the government. There's also a dominant corporate influence in Washington, D.C., and essentially a deteriorating rule of law, just as we were discussing with respect to MF Global. And finally, there's also destructive tax policies. So of those issues, I just enumerated 8 different problems, basically. Occupy Wall Street and the Tea Party would be in agreement about roughly 7 of those 8 issues as to that those are problems we need to solve, and that those are the main problems that need to be addressed in our economy and politically right now. The difference, of course, is in what the proposed solution is. The Tea Party would basically roll back the government and cut the government and reduce it to a size where, even if it were hijacked by Wall Street or by corporate interests, it would be ineffective in derailing the economy or essentially robbing the American people. The Occupy Wall Street camp, on the other side, really wants to just harness the power of government themselves. They want to wrest control of D.C. away from large corporations and big banks to serve their interests. In other words, they want to bend the power of the government to tax and to confiscate wealth to their own purposes. So what I would say is that if you characterize the basic problem as theft, as economic rent-seeking, that this is not a sustainable or productive system, at least the Tea Party wants to end theft, whereas Occupy Wall Street wants the government to steal for them.
That's some very interesting insights, Ron. And, I think this is a fundamental problem with not just, our financial system, but our educational system and our culture, is that, people have grown up thinking that, at least I was taught in schools, that the government's allowed to basically do what it wants as long as, we're protecting American interests, and that, we shouldn't question the government. And, we're taught Keynesian economics in pretty much every single university we go to, and that the Keynesian economics allows the government to continue to, grow in size and create jobs in the government. And I don't like the way the things are heading, and I think a lot of it is because of the things that we're taught, we were taught in schools and by our culture and by the mainstream media.
I think that's exactly right. In fact, I would characterize this, everything we're talking about, if you want to frame it in a Keynesian context, I would say that what we're struggling with is the unholy alliance of John Maynard Keynes. And what I mean by that is that Keynes himself was a banker. He served at the Bank of England, so he was in favor of central banking. He was in favor of government deficit spending, although, to be fair, his theory has been misused for perpetual government deficit spending and reckless deficit spending, and I don't think Keynes ever would have condoned that use or application of his theory. He never would have supported that. But having said that, this idea of the government being a large and active participant in the economy, that is Keynes's idea. That is essential to his basic theory. And for that to happen, you have to have central banking. Well, what happens when you have central banking and a large government that's influential in the economy? What happens is just what we've seen. What happens is that large corporations and banks that grow up around the central bank essentially seek to influence the government. They seek to basically take over the government. Those words are strong, but what I mean is that the government becomes a major customer. The government controls trade policy and economic policy. So every large business must seek to influence the government. And what do you call it when large corporations and big banks influence the government? That's called fascism. And so that's the unholy alliance. There's 3 components: the central bank, the large government, and the corporate influence. It all goes hand in hand, and underlying all of that is Keynesian economics.
Yeah, I completely agree, Ron. And since you have a unique background, you have a practical background as an actual successful business person. Before you got into learning Austrian School economics, before you moved into the resource sector, you have that technology background. I was wondering if you cared to comment on how the business schools, a lot of them are teaching these young entrepreneurs now that the best way, to build a business is to go get government money and grants and, go sell large, have all your business to sell to the government, because I don't think that's a good long-term business plan. I think that ends up as rent-seeking too, like with Solyndra types. I think, entrepreneurs should design businesses where they don't need to take a single dime from the government and they could survive and thrive and grow and stuff.
I completely agree with that. We've gone from a paradigm of wealth production, of wealth creation, to a paradigm of consumption and a paradigm of economic rent-seeking, where we don't produce wealth, we just try to siphon wealth off. In fact, rent-seeking, economic rent-seeking, which is analogous to parasitism, that is the dominant model of the U.S. economy today. And it is not sustainable, and it is immoral.
Oh, I agree. And I believe one example of what Jason was talking about, how entrepreneurs and companies rely on government grant, is the alternative energy industry. I mean, a lot of the solar companies and the biofuel companies rely on Department of Energy for grants to start up their project. Do you agree?
Well, I think the cure for dependency on foreign oil is ultimately high oil prices. It's just that we have vested interests here in the United States. I mean, basically the oil companies and to some extent the automotive industry that really want to prolong the use of these fossil fuels as long as possible, and that's in their interest, and I understand that. However, there are also alternative energies that are economic today. Geothermal and hydroelectric power are economic today, so I don't really see a problem. I have many colleagues and friends who are lean towards being extremely I don't know what the right term would be, but almost anarchistic, right? They just want to reduce the role of they want to reduce the role of government to a radical degree, and I'm not an anarchist. All right, I think that there is a role for government. I think the government can have policies that would promote energy independence, but subsidizing things that are simply not economic, obviously, is not the answer. Free enterprise can create those solutions.
Yeah, exactly, Ron. And the problem I have with solar is that, the solar company CEOs in a free market, they would be forced to switch, to the best solar materials immediately. And from talking with solar CEOs, they don't want to do that. They actually thought, in our discussions with them, that they should be getting more and more subsidies. So that's what we've been hearing out of them, is that they are entitled to continue to build these technologically inferior silicon wafer panels with more government money. So that's not the attitude, from someone with a company that I want to put any money in. I want someone that says, I'm going to switch to the best technology immediately. I'm going to take calculated risks. I don't need any government money. I'm going to do it the best way I can, the most efficient way I can. It's not that, there's better technology out there, but I'm not going to switch to it right now. I'll wait 5 years and make some profits first.
Yeah, I would agree with that, and I would say that an entrepreneur would look for ways to improve that technology and to harness new technology. That would be the basic fundamental approach. And going back to this question of Austrian economics versus Keynesianism for a moment, I think that most of the people that I know that have actually had experience in a business where they created a real product or created a technology or produced wealth, most of those people intuitively grasp Austrian economics. It's not a hard theory for them to get their minds around, because that's really how the economy works. It is independent human action that drives economic activity. That's what it is. So it's actually Keynesianism that's an artificial academic theory that's being imposed on the economy and that fosters central planning, which is very destructive.
That's exactly right, Ron. And, this is, like you said, this is creating a dilemma between the economic rent-seeking of Keynesianism versus the long-term value creation of, allowing a strong private sector where there's going to be firms that fail, but, consumers are going to benefit with a higher quality goods and services at cheaper prices, and that's, beneficial deflation in terms of purchasing power, because in the Austrian school, that's what the Austrian school does produce, with the freer market, is it produces, beneficial deflation in terms of purchasing power.
Yeah, and I think we come to almost the heart of the matter here, tying things together with Occupy Wall Street, and that is that there is some thought that essentially capitalism has failed, that we tried all this free market economics and it didn't work, and that we should move closer to socialism. And that's very compatible. I mean, my statement is not complete, but it is compatible, I think, with what many of the Occupy Wall Street supporters believe. And the problem with this is that we have not had a free market in this country. The market for money in this country was co-opted by the Federal Reserve in 1913. We haven't had a free market in the banking and financial services sector for almost 100 years. And as the government has grown and has become more involved in different industries, whether it's the housing industry or the mortgage industry, whether it's education, or even whether it's energy, these are all areas where the government has intervened and where they've provided subsidies, even in the farming and food industry. So those are areas where the economics are distorted, where the prices are distorted, and where companies have come in and exploited the government interventions. They've harnessed and taken control of those interventions for their own benefit. And that's what we call crony capitalism, essentially. This is a corrupt system, a system that's a fascist system. This is not a capitalist system. So as far as free markets versus a socialist system, for example, we're not having a legitimate debate in our country today because we don't have a free market. We don't have capitalism.
Yeah, and what upsets me the most, Ron, is that, free markets and capitalism get blamed by, basically everyone. Even the Republicans, a lot of them are not, defenders of free markets and real capitalism. They even want, I think George W. Bush hired more regulators during his term as president.
Well, given the situation that we're in, it may be appropriate to increase regulation in particular areas. But let's set that aside for the moment. The fact is, we're in an untenable situation where the economics are very distorted. But getting back to the root problem, we have central planning. And the first example of central planning is the Federal Reserve itself, the central control of interest rates and monetary policy. The Federal Reserve was put in place to backstop banks. It was also put in place for the benefit of the at that time East Coast banks that would then maintain concentrations of reserves, because they were tied to the Federal Reserve. It became primary dealers for sovereign debt and so forth. So this is a system that's absolutely not an example of free market economics. What it is exactly central economic planning. So when we talk about socialism or communism, we're talking about central economic planning. And everybody knows that in that context, when you say the word central planning, that's a system that doesn't work. It's failed over and over and over in the history of the world. But that's what we have here. It's just that we're calling it capitalism, and it's not.
I couldn't agree more. And one of the big reasons why we have a big gap in wealth is because of the bad monetary system that this country has. The Federal Reserve, they socialize the losses of the bank, and they privatize the profit of the bank. And one of the reasons why we have a big gap in wealth. And I just want to ask you one final question regarding the Occupy Wall Street movement. What do you think will be the outcome from this protest? Do you think this will just die down and go away, or do you think this will impact America in a good way or a bad way?
No, I think that the Occupy Wall Street movement is the second wave in a developing situation, and what it has to do with is the failure of democracy and the failure of democracy and what we've been erroneously calling capitalism, this sort of crony capitalism, this fascist arrangement of preferred corporations or special interests that are supported by the taxing power and regulatory power of the government. That marriage of democracy and what you could call fascism, which is simply the merger of state and corporate powers. I'm just using a technical term here. I'm not saying it for effect or to make a political statement per se. I mean it in a technical sense. It's a fascist system. So this marriage of democracy and fascism is over.
Great. Well, Ron Hera, I would like to thank you for coming on the Wall Street from Main Street podcast. If people want to find out more about what you do, where can they go?
HeraResearch.com. It's HERA research.com.
Great. Well, thank you for coming on the podcast. Hopefully we'll be able to bring you back on in the future.
Thanks for having me on.